basically, don't ever go back to the highs again. Don't even approach them. Don't even go back to 34 again. Okay, if you do, you're not going to stop this time. And we suggest strongly that if you get back up there again, and then you get gold back up within $50 of its high, you hit 2,800, you get back up in the mid 2,700s again, and I think we traded over 2,700 this week at some point. You get back up in the mid 2,700s, not even back to the 2,800 high. Don't count on the next advance being similar to the ones we've seen this year, meaning 2 steps forward for gold, 1 step back, 3 up for silver, 2 steps back. Expect something far more dramatic. And we bet that when that occurs, when silver and gold percolate back up toward those levels, the prior highs.
Recent developments in the stock market, particularly with the S&P 500 and NASDAQ showing signs of overvaluation, have raised concerns among analysts. Many warn that these indices could be approaching a correction phase, signaling a potential shift in market dynamics. Michael Oliver suggests that the market is testing long-term momentum support levels and may experience a gradual correction with increased volatility. This increase in market volatility could drive investors away from riskier assets, such as equities, pushing them towards safer, more stable alternatives like gold and silver. Historically, when the stock market faces significant pressure, assets like gold and silver tend to see upward price movements as investors seek safe havens. During market downturns, such as in the 2000s and the 2008 financial crisis, gold and other precious metals saw substantial gains while stock markets faltered. Michael indicates that investors may now be beginning to hedge their positions in anticipation of potential market instability. This shift in sentiment is reflected in rising Treasury bond prices, which have improved after a period of underperformance. This suggests that asset managers may move their portfolios towards less volatile assets. If this trend continues, it could signal that institutional investors are preparing for a potential downturn in the equity markets, which could drive increased demand for precious metals like gold and silver. Although gold is currently in a corrective phase, with its price hovering around $2,645 per ounce, analysts remain optimistic about its long-term prospects. The broader macroeconomic environment, which includes rising inflationary pressures, escalating global trade tensions, and potential economic slowdowns, is expected to favor the precious metals market. As we bring you clips from the discussion, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this.
Well, if you just look at if you bought the news, S&P, NASDAQ, like November the 6th, the day after the election, you had a massive upsurge, and November 5th and 6th, excuse me. The 2 days right after, you had this massive gap-up type surge, and the metals, monetary metals, did quite the opposite. Silver and gold are trading now back above the price level they were when people sold the news. So if you sold the news of the election, Trump's going to defeat inflation, all this, you're losing right now. Silver and gold are actually back above those levels. S&P and NASDAQ are above the levels where if you bought the news, you're still making some money. Not a lot, but you're making some money. But it's interesting, the monetary metals have regained that loss and are trading higher than they were post the election. I think what's restraining, we still anticipate the monetary metals will have a vertical phase. And you remember the monetary metals took off back in March. We beat the table. We said they're going to accelerate up out of this 3-year wide range. And at that point, silver was trading between $25 and $26. And gold was just above 2,000 yet again. It had been above it a couple times before. But this time it's different, we said. We're going to take off. And they did take off. I mean, gold's no longer 2,000. It's 2650 area, trading right now as we speak on the front month contract. And silver's trading 3160. Back then it was 2526. And it's actually up more on the year, marginally right now, because the S&P's gained some of the last, since the election, and NASDAQ has, and gold and silver have cooled off. But they're still actually up year to date more than the S&P and the NASDAQ, which nobody realizes. They think it's, they got to be beaten, but they're not. They're actually up more than the S&P and the NASDAQ. And we suspect the key ingredient now to engage the silver and gold into a stronger upside is to break the stock market. I don't mean you have to crash it. Start to get the blood flow out of the stock market where the assets start to get nervous they move elsewhere. And there's no time in history where when a stock market collapses, everything else goes down too. There's always some other place they go. And history has told us, 2000 to 2002, 2007 through 2011, gold went up with a break in 2008, but basically rose while the stock market went down. Same as the dot-com tops. Gold went up during that time. So did T-bonds. It was contra. It was a place to go. And if you'll notice in the recent 2 weeks, the T-bonds, which have lagged gold in terms of being an upside alternative, they've been under pressure. They turned up sharply. So somebody's buying T-bonds now. And it's not related at all to the Fed, because if you look when the Fed cut rates in September, T-bond prices went down, yields went up. So it didn't matter what the Fed did, the short end. But suddenly for the last 2 weeks, some asset managers have been buying T-bonds. Why? Are they nervous? Are they starting to vacate their stock positions? If we see any wobble in the stock market, I think you're going to see the monetary metals gain from that blood flow. And the next quarter could be very dramatic. It's another one of those pauses where, remember, between 2020 and 2020, early 24, you had this up, down in gold in a range. And you had silver in the staircase to the downside, overlapping. It would go down and go halfway back up, et cetera, et cetera. That tone has totally changed. Now it's all upside, but with pullbacks. So for silver, it's like 3 steps up, 2 steps back. For gold, it's like 1 step up or 2 steps up, 1 step back. Silver's always more erratic, okay. It gets punished more in the pullbacks than gold does, and then on the upside, it gains more. But even that type of behavior, which is different from the prior 3 years, it's a positive direction at least, even despite the pullbacks. I think it's going to accelerate to where you go up 5 steps and then pull back 1, not 2 steps, okay? And I think that tonal change will occur once asset flows start to leave the stock market bubble. And therefore, our focus right now is primarily on the S&P and the NASDAQ 100. It benefited the stock market in the dot-com bubble, okay? You can look at the Fed funds rate chart then too. You'll see that they cut rates, and a bit lag to that, the market took off. And then they started raising rates during late in the rally. And when the market finally topped, they started cutting rates again to save the market before it actually had collapsed, before the 2000 dot-com became a collapsing instrument. It was by 2002 before you realized it was really in trouble. And 2007 did not get bloody until late 2008, but they started cutting rates at the top. Now, they've already started cutting rates because they sense something. They see something in the data. And as we know, Powell has said, okay, this inflation mandate, that's one thing. Well, we're focused on the jobs now. And he knows the job data is not good and is not getting better. So they've already shifted. But when you look back at their shifts that occurred at and shortly after those major tops, it did not stop the downturn. The money flow did not help at that point because they had already created the bubble that once it broke, reality took over and they couldn't stop it. Instead, that money flow that they created, the river flow, asset managers, instead of putting it into stocks, put it into alternatives. They bought T-bonds, they bought gold. And I think we're beginning to see that now. Already early this year, gold has exploded. Silver's exploded since earlier this year. And T-bonds are shooting back up again as if somebody wants them for some reason. And they have been moving almost weekly opposite to the price direction of the S&P and the NASDAQ. T-bonds have. And now suddenly they just shot up very strongly this week especially. Why? If we start to see weakness next week in the stock market, we'll see, the inversion still exists. So the Fed can do that and it won't help. That's what I'm saying. I think, you don't want to ever take silver anywhere back near the 35 level again. Let me put it that way. Basically, don't ever go back to the highs again. Don't even approach them. Don't even go back to 34 again. Okay, if you do, you're not going to stop this time. And we suggest strongly that if you get back up there again, and then you get gold back up within $50 of its high, you hit 2,800, you get back up in the mid 2,700s again. And I think we traded over 2,700 this week at some point. You get back up in the mid 2,700s, not even back to the 2,800 high. don't count on the next advance being similar to the ones we've seen this year, meaning 2 steps forward for gold, 1 step back, 3 up for silver, 2 steps back. Expect something far more dramatic. And we bet that when that occurs, when silver and gold percolate back up toward those levels, the prior highs, that you're going to see the S&P oozing down toward what I mentioned a while ago, toward those levels aren't far below. And that is, I think, the key factor in igniting the metals into a more vertical phase.
The recent milestone of Bitcoin surpassing $100,000 has certainly captured significant attention, but growing concerns about the sustainability of this sharp price increase are emerging. Michael points out that Bitcoin's rise appears strongly correlated with the NASDAQ 100, indicating that its performance may be more closely linked to broader stock market trends than previously realized. Some analysts view the current surge as a speculative bubble, acknowledging the excitement around Bitcoin's new highs, but questioning its long-term viability at these levels from a technical perspective. While the rally has been celebrated, doubts are rising about Bitcoin's ability to maintain its upward trajectory without facing significant corrections, echoing past market bubbles. Michael predicts Bitcoin could face a short-term pullback, particularly if the broader stock market experiences volatility. He suggests that a potential wobble in the NASDAQ and S&P 500 could result in a corresponding decline in Bitcoin's price, with estimates indicating a possible 4% drop. While such a decline may not lead to a catastrophic crash, it could signal that the market is overheated and due for a correction. This pullback would likely reflect broader market dynamics and serve as a cautionary signal that the current rally in Bitcoin may not be sustainable in the long term.
I don't trust the Bitcoin move. I think it is highly correlated to NASDAQ 100. I think it is a bubble, and we have technical reasons to distrust this surge that went through 73,000. Oh, it's joyous. There's no question, but the sustainability of it is highly suspicious from our macro technical point of view. So we're doubters, okay? Not negative right now. We've got some levels below that will turn us negative, but I'm highly suspicious that it is almost impossible, frankly. Our long-term momentum of, quarterly momentum of Bitcoin is in a position where if you keep going up, it's not going to confirm. You'd have to literally leave the earth to confirm it. And I don't think it will. Too many other the more intermediate metrics that we look at, intermediate trends, say, no, you're overbought, you're going to wobble, and you can't afford to wobble. This is a headline event. I like to link it to the tulip bulb mania. Okay, it is highly correlated to the other bubble out there, which is primarily it's U.S. stock market, but mainly the NASDAQ 100, which has been the leader index all the way up, and more than doubled what the S&P did since 2009, and it will lead the downside. And they're both, of course, beating their chest right now, especially post-election. And so I guess you buy the news, right? Okay, we shall see. I'm highly suspicious that by the end of this month, we will have a wobble, especially in the stock market. I think Bitcoin will likely reflect that. I don't mean a collapse, a wobble, a subtle wobble. Let's call it 4% or so off where you are right now. There's a problem with that. I'm talking NASDAQ and S&P right now. If you have that kind of wobble, that doesn't do any damage to the price charts. But our quarterly momentum is very eerie. In other words, when we look at the momentum of the S&P and the NASDAQ 100, yeah, you see the price doing this upward curvature thing. But when you look at momentum, you see a floor that's been used and used and used. In fact, there's 2 floors on each. There's the upper floor and the second floor, but they're very close together. So it's like two sticks of dynamite. You drop back and close this month with a wobble. I don't mean it doesn't have to close down on the month. Just close back for example, I'll give you my best guesstimate. 5,800 on the S&P. It's only a couple hundred points below you right now. That's still up on the month, for example. NASDAQ 100, it's 20,700 is kind of my projected monthly close. That is, if we wobble just a teeny bit next week, I think you're going to probably see a further oozing back by those indices. The problem then is as soon as you open the next quarter and see the momentum structures, they would say, ooh, that's eerie. You don't want to go there. So anyway, I think we're setting up for that. Now, that also will have major wave effects on the monetary metals. We updated XLF, which includes bank stocks and also asset managers and insurance companies. And so it's the financial ETF, broad financial sector. And it's getting hit this week. Now, NASDAQ's up, S&P's up. The financials are down, and frankly, they're trading right now with a couple hours to go in the week below their a level that we didn't. If you close below it, it isn't a good sign. Okay, so despite the chest beating by certain narrow sectors within the market, particularly tech this time, Nvidia's popped back up again, not to its highs. It's still well off its high it recently made. But you've had enough of a bounce to where NASDAQ is leading the charge this week. But look at the other sectors. Look at commercial real estate, RWR. It's a very vulnerable sector financially. Look at XLF. Why are they down? Why are T-bonds up? Anyway, you got to watch these things because these are the factors that ultimately will play in an enormous way. The debt problem is not going to go away. I'm talking the commercial debt primarily here. I think it's a bubble. I think it's the bubble, it's the headline chasing bubble. And I know there's a lot of positive assumptions about what Trump might do or can do, but not all. Okay, you scrutinize down the list of some of his appointees, you don't quite get this total free market thing or total change view. And now with Elon Musk and Vivek Ramaswamy, that's different. They're headed in the right direction. The problem is they can't simply dismantle this stuff. They can't just pull a plug and say, okay, it's over. They have to go to Congress to get approval on a lot of these things. It's going to be delayed. It's going to be fought. It's not going to be so easy as they think. And there's the other problem, and the problem would have existed no matter who got elected. We have a stock market bubble. It is the biggest stock market bubble in U.S. history. It's been going on since the 2009 low. And if you look at a money supply chart, you'll see why. Greater monetary growth in the last 10, 15 years than any other prior 10 or 15 years. And Fed funds rates during 10 of those 15 years have been at zero. So, I mean, they've been giving money away. So no wonder the market got fueled into a bubble. That bubble will break because it's created errors, embedded economic errors, micro errors by individuals, families, companies. And usually that occurs once the stock market breaks its technicals. And we're saying right now, the technicals for massive breakage in the stock market are literally single-digit percents below, especially when we get into next quarter. And all you got to do is the rest of this quarter, the remaining 3 weeks, is to see a minor wobble, and we're with the nooses around the neck. And it's at that point, then suddenly all the data metrics that the Fed likes to hang their hat on, they'll panic. And therefore go what? Monetary expansion, all the panic methods they use. And that will benefit primarily what? The monetary metals.
Gold and silver remain in a consolidation phase, awaiting a new catalyst to drive significant price movement. As mentioned last week, the market is currently balanced on a knife's edge, with investors navigating rising inflation risks, geopolitical uncertainties, and a shallower easing cycle, all contributing to a stronger U.S. dollar and higher bond yields. Despite these precious metals' recent lackluster price performance, analysts are still highly bullish on their long-term prospects. Financial institutions such as Bank of America and Goldman Sachs and Canadian banks like CIBC are forecasting that gold could reach $3,000 an ounce shortly. However, it may take some time for gold to regain momentum as the market adjusts to the policies of President-elect Donald Trump. Analysts anticipate that gold could rally in the latter half of the year, driven by the growing risk of a global trade war. This could stoke inflationary pressures and impede economic growth. As these factors come into play, gold and silver could see renewed demand as safe haven assets, ultimately pushing their prices higher. Please share your thoughts on Michael's analysis in the comments below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.